All right, welcome everyone. This is our April webinar, April 2023 webinar, and we're going to be discussing the Secure 2.0 Act. And I'm very pleased to be joined by my colleague, Jerrod Ferguson, who's the Vice President of Vance Wealth. So welcome, Jerrod.
Thanks, Sean, for having me.
Yeah, absolutely. Like, this is gonna be a lot more fun for me because a lot of these webinars that I tend to do are just me talking to the screen. So I guess, we actually get to have some interaction. Now, I will warn the audience, as Jerrod and I were preparing these slides and looking through the content, and this is just me on my soapbox a little bit. It's kind of like, what is our government doing wasting time with all these small little tweaks? Now, there are a couple cool things that came out of it, but all this new legislation, basically, it just added more complexity, more rules. It didn't actually simplify anything, which gets to be really frustrating. Now, from our perspective, that's one of the things that we're really good at, is understanding the rules so we can help our clients make the most of them. But really, it's just a whole new set of rules. And again, some of them are advantageous. So we're going to cover that today. But, we're kind of shaking our heads. Like, we had our politicians sitting around making these tiny little micro decisions, which, from our perspective was like, all right, they could have just made some really big decisions to actually simplify things and make it a lot less complicated. But we know that's not the MO for Washington for sure. So.
Yeah, I think it was 160 pages is what I read, is like the piece of the legislature on this Secure 2.0 Act alone. And it seems like a lot of pages.
Right. Yeah, a lot of pages. And again, just more provisions that, as investors and individuals have to learn about. But, today you're here. We have pretty good attendance. And so we're going to do our best to cover some of the highlights, really how it impacts our retirees and people who are saving for retirement. Just a couple housekeeping items. So we will be doing Q&A kind of throughout the conversation. So Jerrod and I will both be monitoring them as we go through our conversation today. So if you have questions, just go ahead and put them up in the queue. If they're too personalized based on your individual situation, then we'll likely jot those down and get back to you on a one-on-one basis. But if we feel like we can ask those questions and it would be a benefit to the entire group, then we'll definitely answer those. So let's just kind of jump right in, and we'll discuss what we're going to go through today. So the Secure Act, actually the initial version of it was in 2019. And we're going to go through the Secure 2.0, which is an update as of the end of last year. And just a couple quick highlights as we were looking at essentially what some of the big changes are. They made some adjustments on the RMDs, which is required minimum distributions. They also put in a cool provision around 529 college savings account and the ability to transfer to Roth IRAs. They also launched some new Roth accounts, Simple Roth and SEP Roth. So that's now a thing that we can actually advise you on in terms of doing some good Roth planning or tax-free planning. They also put in some provisions around the IRA contributions will now be indexed for inflation, kind of automatically. And then there's some other cool, I use that term loosely. There's some other interesting changes and planning opportunities. So, all right, Jerrod, take it away.
Yeah, I think there is a lot of good things, but I think it definitely didn't make things more simple, right? When you look at the Secure 2.0 Act, we wanted to go back to the Secure Act, which was passed at the end of 2019, just to kind of see, like, where are we coming from, right? What got updated? And I think one of the big items was the RMD age going from 70 and a half to 72. So I know that created a lot of confusion around, is it the year I turned 70 and a half, or do I wait till 71? And so I think having it the year you turn 72, that cleared things up. So that was good. The age limit for IRA contributions had been removed. And that was basically, if you were working into your 70s and you had earned income, you were still able to fund a retirement account if you wanted to. This was a big one, the inherited retirement account distributions, the 10-year rule. So that really eliminated the stress provisions, which creates a lot more planning opportunities. But you think about, if one of your beneficiaries inherits $1 million retirement account, presumably they have to spend it down over a 10-year period, a non-spouse. And so that's on average $100,000 a year. I think what we didn't get in this Secure 2.0 Act is any clarity around, does it have to be distributed equally? Can it be weighted all the way till the end? And honestly, we're still asking those questions. And I think depending on who you ask, there's really no clarity there. So that's unfortunate. We didn't get a better understanding with that. In terms of long-term part-time employees, and so they're eligible for 401ks. It was 1,000 hours, now it's down to 500. So I think trying to encourage people being more eligible or sooner and easier for retirement account savings, and then increase flexibility around 529. So you can use up to 10,000 a year for high school, and then also you could use up to 10,000 a year to pay off qualified education loans, and actually of siblings as well. So that was a pretty cool provision passed with the original Secure Act. And then various tax credits. So this was big on our retirement account side, or I guess 401k side of our businesses. There was a lot of these credits that businesses were able to earn, and it was up to $5,000. So that's back in 2019. And so clearly we're looking at the Secure 2.0 Act now that just got passed.
Yeah, so I learned something today. Jerrod kind of said, "Did you know even know what secure stood for?" And both of us had no idea.
Yeah, for the record, I didn't either.
So which is kind of crazy. Like this is the first time I've seen it written out this way. So it's setting every community up for retirement enhancement. And so that was signed into law at the end of 2022. Again, part of this Appropriations Act. And so again, I think their objective was to the attempt to expand and promote retirement savings. Like I said, don't get me on my soapbox. I have probably a lot different ideas on how to do it, even with less rules, and make it more simple. But that was really their focus, is around structuring the retirement savings plans and the tax code around incentivizing people to take care of their own retirement and save more. And how do we put provisions in place to enhance that and make it more appealing? So that was the goal. And so today we're going to go through and focus on some of these planning implications. A lot of this is getting rolled out in phases. Some stuff is effective immediately. Some stuff is 2024. Some stuff is 2025. So be a little bit careful when we're going through these topics to keep an eye on what years they apply for. And then just know, part of our disciplined financial planning process, as we start looking at tax planning for our clients, we'll be integrating this into our overall plan, because all of you are individuals and have your different ages, you have different financial needs. And so we'll be weaving this into your individual plan as it pertains to you.
Yeah, so what we wanted to start with was a key item, which was around the retirement age, required minimum distribution age. And so originally, again, it went from 70.5 to 72. And so anyone who turned 72 between 2020 and 2022 had to take their RMD. So if you turn 72 in this year, in 2023, you can delay. And any individuals turning 73 between 2024 and 2032, you have to take your RMD at age 73. So really, if you're looking at birth years, like when was I born, it was 1951 to 1959. And I know a lot of people had heard, is it 73 or 75? And so I think that's where some complexity comes in, and they didn't make things more simple. Like John had said, for the next, say, 10 years, it's 73. But if you go to the next slide here, at 75 kicks in. Let's see if I can advance here. 75 starting in 2033. So individuals turning 73 in 2033 and beyond. So if you were born basically 1960 or later, the RMD age is 75. So I think you look at the question and answer. This is something that comes up. It's pretty rare that clients will actually wait until the following April 1st. But this says, if I turn 72 in 2022, but delayed taking the RMD until April of 2023, the required beginning date of your RMD, since the RMD age changed to 73, do I still have to take it? And the answer is yes. In the case of the individual who turned 72 after December 31st of last year, the applicable age is 73. So you still actually technically have to take it for last year, and then you have to take your RMD again for 2023 and beyond. So it creates some planning opportunities, I think, going forward. And I think some of those items Sean's going to cover here.
Yeah. So one of the things that we recognize, and this is a big part of the planning that we do, and those of you who are working with us, especially from I would say age 55 till about age 70 and now age 75, we have a unique planning window where we can make decisions around IRA contributions, Roth IRAs, Roth conversions, right? So there's a lot of decisions that we can make, and we do all of this planning to limit or lower your overall lifetime tax liability. And that's in things like, how can we lower taxation of Social Security benefits? Can we keep you under certain Medicare premium thresholds, right? So that's where all this advanced planning comes in. And this is where the stuff that we really get into the weeds to understand this, because our goal in this is, if we can save money, we would like to. And so we really need to understand the code. And so with the RMDs being moved back to age 73 for the foreseeable future, and then age 75 out in the next decade, is it really allows for more thoughtful planning. It expands the window. So before Secure Act 1.0, essentially, we had a window that was limited to 70 and a half, and now it's expanded. So it gives us more time. So basically gives us a longer time to execute Roth conversions, which gives us just a ton more flexibility. And, that's really, when you look at what our objective is when we do Roth conversions, especially in your 60s, we're doing it to try to potentially pay less tax during your lifetime. We also look at the next generation, because in many cases, retirees don't need all their resources. They know they're going to leave a large inheritance to their children. And right now, leaving it in the form of an IRA or 401k is not very efficient, because of the new 10-year rule that they have to spend the assets down over 10 years. And so getting rid of that stretch provision really hurt, but it just opened a new window for us to be more thoughtful about the planning. And that's, that's obviously really important to us. And so just as that reminder, if you haven't been aware of that, the stretch provisions are gone. And so with clients that have large IRAs, and large is a relative term, but we start seeing IRAs that are north of $1 million, $2 million, $5 million. We know there's going to be a potential big tax liability for that next generation. So it enhances the planning, and so we just need to be even more focused. And again, we have now a wider window to deal with.
Yeah, I think it's going to be even wider when it's 75, right? Because if clients are delaying until Social Security age at 70, now there's a 5-year gap to actually start doing that planning versus 2 or 3. Yes, that's nice, but being able to actually stretch it out 5 years is really going to increase some of those planning opportunities. There was a question that came in that said, does any of this apply to someone who's retired age 73? And I think the answer would be yes. If you turn 73 in 2023, you're taking an RMD.
So you're taking that, but you were taking that anyway, essentially, right? Because
correct. Yeah.
So nothing really changed. It's just a reaffirming that, yep, you turned 73 this year. Yeah, they bumped it back, but because of your current birthday, you're basically you follow the rules. You would have had to take the RMD anyway.
Yeah. Qualified charitable distributions, or a QCD. These are some related changes, but I guess first, what is a QCD? This is one of our favorite planning opportunities for retirees who have maybe low medical. They don't have a mortgage, so mortgage interest reduction. They're basically itemizing in retirement, but they're charitably inclined. And so, obviously, I think the first goal of giving a charity is to give back and to obviously benefit the charities that you are passionate about. But, we don't want to be naive. If you can get a tax deduction or reduce your income, we want to try to do that. So I think when this qualified charitable distribution came out, it allowed for a lot more planning on an annual basis for those types of clients. And so, a QCD is basically a distribution directly from a retirement account, an IRA or SEP, to a qualified charity. So a 501c3 organization. And this does not include donor advised funds or private foundations. You can give up to $100,000 per person, essentially per account.
Per year.
Yeah, per year, which is pretty amazing, right? So if you have to take out over $200,000 and you don't need the money, you can actually give it all away to charity and you don't pay any tax on it, which is beautiful.
Yeah, and I think, Jerrod, as you're looking at this list, I mean, the big thing to focus on is that bottom bullet point, right? This is where we have so much of the conversation with clients on.
Yeah, because if you wrote a big check and you're itemizing your deductions, if it still goes to charity, it's not affecting your modified adjusted gross income. So that's really big, especially in retirement. Your Medicare premiums are based off your modified adjusted gross income. So adjusted gross income plus tax-free interest is what your modified adjusted gross income is. So when you give a QCD directly from an IRA, it reduces your income dollar for dollar above the line. So before the deductions kick in, and that's really what your Medicare premiums are based off of. So that's a huge planning item that we go through on an annual basis. I think right now, modified adjusted gross income, that kind of first threshold is 194,000, I believe, for a married couple. And so sometimes it's like, let's try to stay underneath that, because if you go $1 over, you're paying an additional $80 per month per person. And so that can start to add up. So,
And Jerrod, sorry, I didn't mean to cut you off, but one of the things that we know all the time is that, we might have clients that, on a regular basis are giving 5,000 a year or 10,000 a year, whatever your number is, it's relative. But where we see a lot of the planning opportunities is that if we run their tax estimates and we see that, okay, they're going to give 5,000, but you know what, there might be $2,000 above the modified adjusted gross income threshold when it comes to the Medicare. And then they make a decision of, okay, well, I'd rather, maybe give an extra 2,000 this year to pull my income below that, because that saves not only income taxes at the federal and state level, it also saves that Medicare surcharge. And so that's a big part of our planning. It's amazing to us, and we understand that because it's a cost, but how kind of mad people are getting when they get pushed into these higher brackets. And so that's where the planning really comes in, is like, let's be thoughtful about it. Sometimes you're too far over it and you can't help it. But if we can, Jerrod had mentioned, like, if you're $1 over, then you pay that extra surcharge. So if we can be more effective, and the QCDs are really one of the best ways to do it.
Yeah, like you said, John, if it's going to go up by $2,000, you could give that away to bring you under. It's like, why wouldn't you do that? Now you can benefit a local charity, your church, whatever you're, kind of passionate about. And then on just for tax filing, I mean, our tax forms will show the gross distribution, and then it'll actually show QCDs at the bottom. And so, I mean, that's another reason why we look at review every client's tax returns, is because sometimes it doesn't get picked up correctly, and you're overstating your income if it's not getting picked up. So that is a quality check that we'll make sure we go through every year. Send us your tax return, especially if you're doing QCDs. We want to make sure that it shows your gross income and less the QCD amount, and then you have a taxable distribution amount, which should be the difference.
You going on to the next slide?
I'm trying. Yep.
So not wanting to move. Okay, here, let's see if I can do it. We locked up.
There we go.
All right, cool.
Yeah, so mostly just around the QCD related changes, not much. I mean, I think the good thing is we saw the RMD age get pushed back. The beauty is the QCD age didn't get pushed back. So if you're 70 and a half, you're eligible to do QCD from your retirement account. That is good news, right? If you're not wanting to take income from your retirement account until you're 73, you can still do a QCD at 70 and a half. So that's something that we're also keeping an eye on. And then the 100,000 was previously capped. That's now going to be indexed for inflation. So that's going to continue to go up year over year, which is also good, especially for people that give up to that amount.
Yeah, and that 100,000 hasn't changed in forever. So having that automatic indexing is good, because that number will go up. The other thing is, I think this was kind of a missed opportunity for our for Congress to actually maybe move the QCD number down to like 59 and a half. Like, why not move it down to when you first can withdraw from your accounts? Because then it'll encourage more charitable giving. And so this seemed like a missed opportunity, but for all intents and purposes, nothing really changed on your end. So it's just kind of business as usual. All right, I'll start navigating ahead, because I think there's a little bit of a lag.
Okay. So let me make sure that, this is probably my favorite thing that got rolled out with the new one, just around 529 accounts and some more flexibility there. I think previously we wanted to just recap what were your options previously, right? So if you had a 529, education savings account for a kid, a grandchild, your options were to cash it in, right? If they weren't going to use all the money and there was money still remaining, you could cash it in and you pay a 10% penalty on the ordinary income tax on any of the gains. So above the cost basis, above what you funded the 529 with. You could transfer it to a family member, and that includes siblings or other children, cousins, nieces, and nephews. I mean, it couldn't be like my third cousin, right? I mean, they're trying to keep it within more immediate family. Or you can leave it in for a future grandchild, right? There's no restrictions or requirements to actually withdraw the money. And so you kind of just leave that for a potential future opportunity. So the Secure Act 2.0 has some newer provisions. which I think if you take anything away from this, this is probably my favorite piece that they did roll out. So now you can actually transfer part of the whatever's remaining in the 529 account to a Roth IRA for that beneficiary. So there's several rules related to that. And so the Roth IRA must be in the name of the beneficiary, right? So if you had a 529, it has to be in that same person's name. The lifetime amount that can be transferred is $35,000. So it doesn't seem like a lot, but I actually just did like a hypothetical. If you grew $35,000 at an 8% return for 40 years, it's 760 grand. And that's not talking about adding more money. We're just looking at the power of compounding at a hypothetical 8% return over, 4 decades, but that puts them into their mid 60s probably. Subject to annual contribution limits. So you can't fund a Roth IRA and then also move, say, $6,500 from a 529 into the Roth in that same year. You can't, double dip or double contribute. So that is one of the limits, and beneficiaries must have compensation. So you have to have earned income to fund a retirement account, to fund a Roth IRA. It's no different to be able to move $6,500 from a 529 to a Roth IRA that year. The 529 has to be established for at least 15 years. And so this is where we need a little bit more clarity, is we're not sure if you actually change beneficiary, say 5 or 10 years into it, do you reset the clock, or is it from the initial funding date? So I think we need to get some more clarity there. It's just everyone's kind of asking that. And then also no funds or earnings that were contributed within the past 5 years prior to the transfer may be used. And so what that guards against is people wanting to mass fund a 529 towards the very end to get a large amount into a retirement account or Roth IRA for that person. So it is a really special planning opportunity for any individuals or families that overfunded their 529s. We're kind of like, well, what do we do with this? Do we just cash it in and pay the tax? Now you can create more incentive for, hey, this money, it was set aside for you for college. You're not going to use it all. Let's actually put this into a retirement account that you're not going to touch for 40 years, but you start them. You kind of start the clock on retirement savings. So I think it's much better than saying, okay, well, this money was for you. Let's just cash it in, pay ordinary income tax, pay a 10% penalty, and then you get the difference for whatever you want. I think still incentivizing that long-term growth of that account really makes sense.
Yeah, and I think it solves one of those issues that we get from clients a lot is, when they say, well, what if my kid doesn't use this? And they kind of feel like it's trapped there. So sometimes they'll kind of take the attitude, well, I don't want to overfund it. So this is a nice add-on to be able to put that money to good use. So thanks for the update on that. So, and just to be clear, you guys saw that on there, but that's effective 2024. So that's not for this year. That'll be in place for next year. This is also another one that's going to be effective for next year. This is a strange one, right? So this goes under the headline of like, why did someone waste so much time with this? But we'll go through this exercise. And so basically, if you're not aware of this, Congress put in place probably over 20 years ago this idea of a catch-up contribution, where basically it was encouraging people to catch up if they're over age 50. So they allowed people over age 50 to fund more money into their retirement plans, which is a great idea, right? It's like, hey, if you didn't get an early start, let's give you some provisions to add more. So, so they added a provision in here that if you want to do your catch-up contributions, but if you are a high income earner, and they define that as having wages in excess of $145,000, that would be for 2024. So if you made over $145,000, I guess it's in the previous calendar year. So again, that's another level of complexity. And so if you do that, then the catch-up provision cannot go into a deductible contribution. It has to go into a Roth contribution. So it's just a kind of a weird part of this, but if you see at the very bottom, no catch-up allowed for anyone in the plan if an age-eligible high-wage earner cannot make a catch-up because the plan does not have a Roth option. So this also may require a bunch of plan amendments. So for those of you who are on the call who are business owners, a lot of times 401ks do not have the provision to add a Roth. If they don't, then this adds a lot more complexity about disallowing the ability to have catch-up provisions. And so this will be something I know our 401k will be working on, making sure plans get amended to put that in place. And so again, this is kind of a strange one. I think that Jerrod and I, we were talking about it. It's probably just more of the fact that you know what, if people are going to catch up, we want to get our taxes. So if you put a contribution in there of $7,000 into a 401k, instead of it being deductible, you will have to pay tax on that. But the benefit is it's still going to a Roth account, which we like.
Yeah, and I think it's the, high wage earner. I think it's relative to where you're at, but 145,000. I think it's maybe a little bit of a penalty or an additional tax on the high wage earners that is not called out in like the tax code, but I think it is making sure that they're getting their tax money today.
Yeah, it seems a little bit arbitrary, but it is what it is. Like, don't shoot the messenger. We're just here to deliver the information. So, so there's another concept that's known as called a backdoor Roth IRA. So many of you that we've had in our office over the years, are not eligible for funding a Roth IRA because you make too much money. And obviously in retirement, if you're not working, you can't fund a Roth because you don't have earned income. And so there is this strategy that's called a backdoor Roth IRA, which basically is higher income earners utilize this strategy to get money into a Roth through essentially a backdoor. So how you actually do this is you make a non-deductible contribution to a traditional IRA. Then what you do is you actually convert the traditional IRA to a Roth. And since the contribution that you made into the traditional IRA was non-deductible and you don't get a tax deduction, when you make the conversion, you don't pay tax on that. So I know that was kind of wordy, but essentially you put money into a non-deductible, you didn't get a write-off, you convert it to a Roth. It's not taxable because you didn't get the write-off at the beginning. So that's essentially how that works.
And John, just to stop you right there, I think the only way that works is if you don't have a balance in your IRA, right? And so every year, if you have a zero balance, you fund the non-deductible, you convert it a day later or beyond that into a Roth IRA, your IRA essentially goes away, right? Until maybe next year when it makes sense again. If you contribute a non-deductible into an IRA that has, say, $100,000 in it, you're creating basis, and this doesn't actually work. And then you track basis, or your tax professional tracks basis going forward. So then a portion of every distribution in retirement is actually non-taxable. That is a little bit of a headache, and we don't really want to do that.
Well, and so yeah, it's a great point, Jared, because oftentimes people say, "Oh, I love this idea, let me do it." But in terms of in order to determine if you can do exactly what we said, is that if they aggregate all your IRAs. So if you have IRA, SEP IRA, any sort of IRA, they look at that as the whole balance. And so when you do this, if you have a balance, there's going to be some tax owed. So before you go out there and just do that conversion, that's definitely something we look under the hood and help you with. But make sure that you just don't set up a new IRA, do this and do the conversion, because if you have other IRAs, that would add to the basis on that. And so getting back to just kind of wrapping this one up, we've been fearful that they were going to close down this essentially, it's a loophole. They were going to close this down, but they did not change this in Secure 2.0. So we can continue to do this. A couple of things is we also want to just make sure when you're doing that conversion, you don't do it same day. You want at least a day to pass between when you do the non-deductible contribution and the Roth conversion.
So this has to do, John had talked about this earlier about cost of living adjustments and effective, again, 2024. So another one to keep an eye on. Anyone right now at age 50 and older can do $1,000 catch-up contribution to their traditional Roth IRA. So currently, if you're over 50, it's $7,500 is the normal. You can do an additional $1,000 as a catch-up. Right. With this new Secure 2.0 Act, these are all going to be indexed for inflation, which is great. I think on the cost of living to 401ks as well. And so I think that we just gave an example. So the catch up for 401ks is $7,500. I think it can go up to 50% of current levels, which is 7,500 on 50% of that, or 150 is 11,250. So that would be the catch up amount for 401k. So I think it's just easier now. I think the goal to not have Congress have to approve these cost of living adjustments or higher catch-up amounts every year. Now that's just going to be kind of standard cost of living adjustment and take care of itself, which is good.
Now, and if you notice on there, it does say that the 401k one looks like it's not going to be effective until 2025. The only thing that might be frustrating, Jared, from our planning perspective is a lot of times we're dealing with round numbers, right? You can do 1,000 or 1,500 or 6,000. So if they're truly doing it on inflation, hopefully we're not going to get weird increases like it's now 1,020 or 1,040, right? So hopefully they're still going to
They're
try
rounding or something.
Yeah, hopefully they're rounding up to something reasonable. Otherwise, it's going to be even harder to kind of track all the different rules as they change every year.
Yeah.
Okay, so that kind of wraps up the more individual components of this. The business owner section is pretty quick, but if we have anyone that's on this call that it's like not a business owner, they don't really care about the provisions, this section is going to probably be about 10 minutes. You're welcome to stay on, but also, and especially if you have some more questions towards the end. I guess I do want to just mention one quick thing. If any of you are going to jump, our next webinar is going to be focused on tax planning. We'll break it down into two sections: personal tax planning, business owner tax planning, and that will be hosted by me in May. Thank you all for joining. And again, you're welcome to stick around with us, but this is going to be really specific on some of the business owner related provisions. And this would apply to you if you own a business, sole proprietor, any sort of business entity, because there's some of the rules in place that are different than before. Okay, so a couple quick things. And so what you can see, we have on the left-hand side key themes, and down the middle we have like what did they actually do, and then when are they effective. So a big part of this was like, how do we encourage small businesses to create retirement plans? And they said, all right, well, if we create tax credits, then they'll do it. So there's provisions in place, and you can see the fine print at the very bottom. If you want to know how this works for you, we can definitely provide you more information on a one-on-one basis. But you basically get tax credit for up to 50% of the startup costs, up to $5,000 per year for 3 years. And so when you set up a 401k, you have to set up a plan document, engage with the TPA. There's just additional costs that go in to running a 401k, running a retirement plan. So there's now tax credits in place to help incentivize you to do it, to help bear some of those costs. That's effective now. There's already been some tax credits in place. These are just the new updated ones. And then tax credit for employer contributions of up to $1,000 per employees for 5 years. So not only does it incentivize you to start and pay for some of those startup costs, it'll actually give you some tax credits for employer contributions that you make. So contributions you make on behalf of your employees. Then the next component here is looking through this idea of this emergency savings accounts and defined contribution plan. So a defined contribution plan is just a kind of the fancy term for a 401k profit sharing. But basically they put provisions in is that you can have built into these is these emergency savings accounts. So that you can fund after tax contributions into this emergency savings account. We haven't seen how this is going to look because this is not effective till 2024, but this will give you the ability to put money in there from your paycheck, and it'll just be a maximum account value. It'll get capped at 2,500, which means it'll essentially fill up, and then you can't put any more money in there. So that's another one to incentivize emergency savings. The next one on here is help manage student loan debt burden. So I don't really know exactly how this one's going to work. The devils are always in the details, but basically employers will be allowed to make matching contributions to the plans for participants paying student loans. So I don't know what the mechanics are of what this will look like, but for those of you who have high student loan balances, or you have children that have higher student loan balances, there's going to be some provisions in place that will make repaying some of those loans easier. Again, stay tuned for the details because this is not until 2024. And then a couple provisions that have been put in place to allow for greater savings into retirement plans. So basically, if you have a new plan, so these are 2025 legislation, and then the last one is 2027. So in 2025, new plans will be required to auto-enroll their employees at a starting rate of at least 3%, and then auto-escalate at least 10%, but no more than 15%. So basically, the idea is you sign up, you're a new employee, they auto-enroll you, you would have to opt out. So now you get auto-enrolled at 3%, and then every year it goes up by 1%. Until you hit 10% or 15%. And so that's going to be built into these plan provisions, because I think the whole idea is there. The whole idea there is that a lot of people don't fund the 401k because it's kind of an afterthought. So if you auto enroll them, it actually will take work for them to not enroll. They'll have to opt out. So by default, people will just kind of like let things happen. And then that encourages greater savings into the 401ks.
And then presumably your income or their income's going up, right, over time. And so naturally it's going to increase by year. And so maybe it's not that big of a hit month to month. where they don't feel it. And so maybe it gets to that 10% level when they start feeling like, okay, now I need to pay more attention to how much I'm actually saving, and can I increase it, or do I need to scale things back then?
For sure. Yeah. And then here's another one, like this is just a weird one to me. Again, these are, our politicians sitting around making up some random changes here. Increase catch-up amount for individuals age 60 to 63 by 50% more than the regular. Like, why 60 to 63? Why not 60 to 70? Why not 55 to 75? Like, it just seems kind of arbitrary, but basically long and short of it, we'll get a little bit more clarity on this issue, but that the catch-up amounts will increase in that short window from 60 to 63. And then the last one is, I guess, we're going to replace the savers credit with a savers match equal to 50% of the plan or IRA contributions up to $2,000. So that's a little bit more on the individual side. But again, they're trying to incentivize more savings. Not sure that will work, but that's what the attempt is. There's a couple just high level things that I do want to just cover around this. This is actually, like, Jerrod got excited on the 529 plan and the ability to move 529 monies into the ROTH. Like, that's a really healthy provision especially for families. This one is, I think, a great one for business owners, especially smaller business owners, where, maybe setting up a 401k is just not in the cards, a little bit more complicated. Now, if you have a SEP IRA, there's actually a Roth style version of that, or a simple IRA, there's a Roth. I don't really know how this is going to work, because essentially a SEP IRA is an employer contribution. And so it only allowed for pre-tax. And so they're obviously going to put this provision in, is now you can fund that, so it's no longer a deduction. So the thing to be clear about that is, when you fund a SEP IRA, you get a tax deduction at the business level, right? Whether it's sole proprietor or a S Corp. And now you have a Roth, you won't get that tax write-off because it's a Roth contribution, but at least you'll have that provision. So I think that's actually kind of a cool feature. It does add some simplicity. It is another benefit of this, but it also is now a lot of our clients who have a SEP and have opted not to do the 401k route can add the Roth provision without a lot of headache.
Yeah, and it's less costly, right? The 401k, you have third-party administrator fees. It just annually, it takes a little bit more money to run on an annual basis, but it opens the door for a little bit more simplicity, but less cost as well.
Yeah, that's a big one, right? Is trying to keep some of the costs down. That's why a lot of these things, when we're going through, every time you add new layers of rules, it usually adds more compliance and more cost for business owners. And I think as a firm in general, we're a big proponent of, like, let's make things simpler and less compliance, but that doesn't ever seem to happen. So the reality is,
would never be a politician, John. That's why we could never be in Washington.
No, it would not work, because we would want to make things easier on people, not harder, and have more rules to follow. So, but I guess there is some job satisfaction, or job security, excuse me, for us, because as the complexity continues to occur, we have to stay on top of that so that we understand the best type of retirement plan for our clients. And then as we go into this last one, so this just is dealing with, this is on the matching contributions. So is this one different, Jerrod, than the other, or is this just exactly the same? Because we were dealing with catch-up contributions. So that's right. This one's the matching contribution.
Match versus catch-up, yeah.
Yeah, so basically, there's going to be a provision in place for employers that if you want to make your match, right? So a lot of employers will put a match in like 3%, 4%, or 5%. You will have the option to do it as a Roth contribution instead of a deductible kind of pre-tax contribution. So the big change I guess, thing to know is that you, as the employee, if you choose to receive it, right now, when you get a match, you don't pay any tax on it until you withdraw it in retirement. However, if you opt to receive a match in a Roth format, then if you notice on here, I think it's the second, which bullet point is it? It's the...
Oh, yeah. I mean, second from the bottom.
Second from the bottom. Okay.
Yeah.
So basically, when you make the Roth, when you opt to have the Roth paid as a match, the match paid into your Roth, you will then be subject to income tax. So if your company matches $5,000 on your behalf into your Roth account as part of the matching, that will then be taxable income to you. Now, the cool thing is on the back end, when you spend that money in retirement, it's in a Roth account, so you won't pay tax later, but you have to pay tax up front. So a lot of people aren't going to want to sign up for that because they're gonna have to pay tax now, and I think a lot of us are taxed.
It's like that phantom tax, right? It's like income that you technically didn't earn or see, but you have to pay tax on it. So, John, there is a question that says, if a small business already has a 401k plan, can they convert to the new SEP Roth opportunity? Kind of going back 2 slides.
Yeah, so I think the short answer will be yes. I still think that they're, depending on the individual situation, it's not going to necessarily make the most sense. It's all going to depend on income, because in order to get a maximum funding into a SEP account, your income has to be in excess of, I think the numbers is in excess of about 230,000. And in order to get the maximum in a like 401k with profit sharing, your income only has to be about 160,000. So that I think definitely part of the planning exercise will be looking at an individual situation and determining, okay, we're using, let's say, a 401k now. Can this be accomplished with a SEP? And if so, let's close the 401k down, get rid of some of the complexity and use the SEP. I don't think it's just going to be like a one size fits all that we just decide, oh, since this is available, it's the best option. We still want to evaluate it. But to Jerrod's earlier point, if we can bring down some of the overall administrative costs, that's a win-win, because that's more money in your pocket. So we'll evaluate those. But it just gives us more options.
That would likely be a longer term solution, right? If you're going to make that switch, I don't think it's easy to go back and forth from a SEP to a 401k, right? To back to a SEP year over year, depending on what makes sense. So I feel like if that was going to be done, you would actually technically want to close down a 401k plan that requires, forms to be signed and submitted and things to be properly closed down. So hopefully if that did happen, it would be more of like a, yes, this is indefinite, and not a year to year thing.
Yeah, for sure. So I am, thanks for the questions. This wraps up our webinar for today. Just as a couple quick reminders, I know we have some guests on the call. If any of you are interested in having a 30-minute complimentary consultation with our advisors, go ahead and book an appointment. We can cover some of these issues that might be unique to you. Additionally, if you want more information on any of these specific items, go ahead and email our team. And usually probably info@vancewealth.com is probably the best one to email. And then our next webinar is tax planning on May 16th at 4:30. So thank you all for being here, Jerrod. I really enjoyed co-hosting this with you, and
yeah,
thanks
for having me.
Absolutely. Take care.